Hello and welcome to our first ever virtual lunch and learn, managing your variable costs. My name is Tim Hicks and I'm in the Strategic Partnerships Department with the Ohio Farm Bureau. So today's program is part of Farm Bureau's continued efforts to help members gain the resources and information to be better farmers and business people. A similar program will be held covering strategies to reduce your fixed costs. But by bringing forward key partners and their subject matter experts, the next several minutes are your chance to gain insight and ask questions to better manage your costs for a more profitable 2021. And so with that, I'd like to introduce our two dynamic presenters for today's session. Micah Mensing is the Ohio Growing Forward Specialist for Farm Credit Mid-America. And as a Growing Forward Specialist, Micah works with young and beginning farmers to provide financing, education, and resources to the next generation of agriculture. And it's also my pleasure to welcome Jess Cambell, Vice President of Food and Agribusiness, Swine. Driven by serving commercial hog farmers, Jess provides specialized solutions to help agricultural and entrepreneurs gain access to capital they need to achieve their goals. So Jess and Micah, I want to extend many thanks to you both and to Farm Credit Mid-America for joining us for today's program. So with that, I'm going to go ahead and turn it over. The floor is yours.
Well, thank you, Tim, for that introduction. Much appreciated. As he had said, I'm Micah Mensing, and my lens that I'm going to come to you all to from today is really focused on that young and beginning farmer perspective. The customers that I work with may be purchasing ground for the first time. They may be buying that first piece of equipment, and they may be working through transitioning the operation from dad and mom to son or daughter. And so that is really the lens that I come to you all from today. And when I talk to you about some of these different pieces and of parts of the puzzle, that's kind of the angle that I'm coming from. And so I'm super excited to have Jess Cambell here with us today. And she's going to balance me out a little bit and give a perspective that's maybe elevated a little bit more and talk to those individuals in the room that are a little bit more established, right? That have an organization surrounding their farm or have or are a CFO of a cooperative, right? And so that segment is really where she's going to bring in a lot of expertise, and hopefully through today's presentation we can kind of balance each other out and really give you a lot of value. And so we're going to have a wide variety of representation that we're going to try to talk about. And so when we framed up this presentation, I went with what I know best and just with what she knows best. And the goal of it is to just be able to prompt you to ask the right questions, right? And so we're not going to sit down and do a specific analysis of anybody's operation here. We're going to talk broad sense so that you can kind of get some insight into what are some of those strategies that allow you to increase your profitability on your operation. And so that when you do go to meet with a lender, hopefully us, that you have the opportunity to sit down and ask the right questions to that person. So why are we here today? Number one, we need to understand the importance of measuring financial performance. And number two, to identify what some of those key ratios are that are out there that allow us to be able to measure our success in cutting some of those expenses, whether that be a fixed or a variable cost. And so that's really what I'm going to spend the majority of the presentation on here, just in the beginning as we get going, is the differences between those. And so let's start out with reducing my cost to increase profitability. That's a pretty big topic. What are the things that we can do to break that down to level set with each other? So I sat down with one of our credit analysts and I said, tell me an ideal state and then show me a representation of what's probably going on in our portfolio. Again, coming from a grain farm is this example. And they said 30% of the income that they have is probably going to be eaten up by land cost. An additional 30% by seed, chemical, fertilizer, followed by 10% in labor, equipment, and other, with 2% being operating interest, which leaves them about 8%. Now, you might be thinking, I don't know if this is ideal or not. The reality is that is very depending on the operation that you have, right? And so this is a grain farm that we're going to look at right now, and as I'm going to use as we go through some examples. But what's important to consider when I show you this is not where do I match up in comparison to this specific example. It's really about how do I need to quantify my expenses to be able to see where my big ticket items are? Where am I spending my money, and how can I reduce some of those costs? And that's some of the strategy that we're super excited to share with you today. So the first thing that we want to get into is our farm fixed cost ratio. And what is our fixed cost? I'm sure many of you know, but to bring everybody up to speed, your fixed costs are going to be those things that you're going to have to pay year in and year out, whether or not production continues, right? So whether or not I have a crop in the ground ready to be harvested or not, I'm still going to have to pay these fixed costs. Couple examples. Those fixed costs could be things like wages. Those fixed costs could be things like land rent. Those are going to be continual expenses that we put on a longer term, right? Maybe a 20 or 30-year term, depending on what it is, that is going to continue to require payment no matter what happens. And so we have to be really cautious and careful about what those fixed expenses are, those fixed costs are. So when we break that down into an actual ratio that allows us to use that information to make decisions, we call that our farm fixed cost ratio. And let me tell you what's in that ratio, and then I'm going to show you how you could use it. So our real estate and term principal demand, our real estate and term interest, our real estate taxes, our rent, and then we're also going to include our value of farm production. And so our farm fixed cost ratio and how we can turn that into a calculation that helps us actually make a decision. What we're going to do is we're going to take our real estate and term principal demand. We're going to add in our real estate and term interest. We're going to add in our real estate taxes, and we're going to add in our rent, all right? And that's going to give us our total farm fixed cost. We're then going to take that number that we get and we're going to divide it by the value of our farm production. And that's going to tell us our farm fixed cost. Now, if you were me, I would look at this screen and say, what the heck does this actually mean for me as a producer? What can I do? What can I take away from this, right? And so we have a tool that I'm going to share with you here in just a minute that allows you to make it a little bit more digestible and understandable. The first tool that I want to show you that kind of leads into this, though, is what we call our farm credit factors tool. What's really neat about this, and I use this a lot with my customers as they decide how aggressive they want to be in growth. But it allows us to go through and put all of our information in here and then run scenarios. So let's run one just real quick. Let's say we have assets worth $1.7 million. And if I can add enough zeros in there, and current liabilities at 500,000, then we can go, and I'm going to add some numbers in here just to be able to have something. And then let's say we're going to go down here and we are going to make a purchase for, let's say, $450,000. We can go in and put all of this information, and at the end, we're going to see, and obviously this isn't filled out to the best of our ability at this point, but we can go down here and see where those ratios going to change as a result of that purchase. Now, this is really, really important because as I'm working with my young and beginning farmers, I want to be strategic about the purchases that they're making, right? And so if they are sitting down and saying, yeah, this is a good deal right now, but my long-term goal is to maybe buy mom and dad's farm or grandpa's farm or whatever it may be, we have to ask ourselves, what are the ratios going to look like after the initial purchase? And are they going to set me up for success for my long-term goals? And so this is a tool I'd be happy to share with you on the call if you are interested and would love to run scenarios about purchases. I don't actively engage in production agriculture myself at this point, but it is a tool that I use to be able to see what different purchases in my life would impact my overall bottom line, right, and my overall factors and ratios. So just one of our tools that we use to be able to figure out those fixed costs and see if we can continue to increase our fixed costs by adding land, or if we should back that down just a little bit and run some purchase scenarios on what would be the best fit for me. So as we talked about ratios on that last slide there, we have a couple risk parameters that we really like to fall within Farm Credit Mid-America. And so we'd love to see our fixed cost below 35%. Now, depending on the operation, depending on the scenario that you're working in, that very well might not be the case, and that's okay. 35 to 40%, we see a lot of growers fall within this area. And then that high, when we're over 40% of our fixed cost, we really have to ask questions. Maybe it's just that grower is expanding aggressively and purchasing a lot of ground. If that's the case, that's absolutely 100% acceptable, as long as there's there's a result happening of that aggressiveness, right? And so we're going to look at this analysis and we're going to say, yeah, I fall within the moderate or I fall within the high risk category, but I have some serious offsetting strengths that are going to be a benefit to me as I continue to grow my operation, as I continue to reinvest in my operation. And so this is really just one of the segments that we look at when we think about farm fixed cost and how can we reduce some of our costs is number one, identifying them, and then number two, seeing where they're at and where they compare to maybe others. So next we're going to turn it over to Jess, and she's going to give us some perspective about farm fixed cost ratios, maybe from her perspective of the customers she works with, and maybe even talk about how risk management can be a way that maybe gets us a little bit more comfortable.
Right. So with my clients, we don't use this ratio quite as much just because of some of the differences, but we are checking for the same effective tools. So let's say that in this example, you're in the red or the high area. That may not be a bad thing if, for example, you're putting up a contract hog finish barn that while you are becoming highly leveraged, it's also providing a guaranteed income stream for a period of time. Or if you're doing an expansion that's fairly aggressive, perhaps that's okay because you have a lot of equity and liquidity on your balance sheet. Or the other piece might be, I'm doing all of this, but I have locked in my puts and my calls on the corn. I have strike futures on my hogs. I've modeled up my crush and I'm protecting a profitability. So you could use crop insurance to lay off risk. There's various tools to lay off risk, but it's okay for some of these things to be more aggressive if we're adequately managing the holistic relationship. And then you can go ahead. So one of the things that I wanted to talk about was, okay, we know that we need to manage our costs and when we all want to make more money. I think we can pretty much all agree on that. So I'm going to use an example from the swine field in which I primarily work in to illustrate the point here and the why behind it and really some of the tangible impacts. So this is a sow farm cash flow that I modeled up. And this is there's one axis here that says PSY. And for those that are not in the swine industry, that means pigs per sow per year. So how many pigs are going out the door? It starts at 24, goes to 30. Then you've got the price that we're selling those pigs at on the other axis from $34 to $40. So Micah, if you want to highlight that first quadrant, let's say you're at $24 or 24 PSY and you're selling for $34. You're going to lose about $1 million in this operation. But their throughput is very, very important no matter what the industry, but especially in a commodity like agriculture. Our goal is to be a low-cost, high-throughput producer. That's how you survive in a commodity market. So let's say that we're getting a little better at raising pigs. We're at 25.8, and now we're selling the pigs for 36.10 on the open market. Now we've gone from losing $1 million to making about $46,000. That's not bad. You might not be able to live on that as a family of four, though. So let's see what happens if we really are able to maximize our production, go work on our throughput and get to 30 PSY, which is achievable by a lot of modern hog farms. So with that same fixed asset cost of the sow farm, the sows, those investments, and then managing the variable costs, we are able to then get ourselves to $1.5 million gross. So, yep.
as Jess just talked about within the swine industry, we want to bring this back to center of the example that we were using just a little bit ago about how can we increase our yields based on a grain farm. So if we were to increase our corn yield by just 5 bushels per acre, if we take that 5 bushel an acre that we are increasing and multiply it by $4 a bushel corn, we're able to increase our profit by $20 an acre. Now let's take that $20 an acre and multiply it by 500 acres that we have that we're doing that. We're able to get an additional $10,000 of income. Now, I don't know about you all, but for me, $10,000 is a pretty significant amount that I would more than happily take by being able to increase my bushels. And so anything to add on that, Jess?
Again, it's really modeling on the factors of what we can control. And one of the biggest things we can control is how much we can get through what we already have that generates income. So let's say we're talking about a widget factory. If you put out 20 widgets a day and you sell those for $5 versus 500 widgets with efficiencies, you're going to make more money with the 500. It's really these same theories of manufacturing. It's almost hard to think about translating to agriculture, but it does. Looks like we got a question from Jack. Thanks for popping in there, and we welcome any other questions if you have them. How do you factor farm program payments into these calculations? We honestly, in most cases, we do not want to count on repayment via government payments. We're talking about usually long-term credit facilities that are 20 years. It would be really hard to assume that for the next 20 years, 25 years, whatever the operations term debt is, that you would be able to count on payments that we've had at the levels we've had for the last three years or so between MFP and CFAP. But it has been quite the lifeline from liquidity standpoint and keeping the cash flow as some of these industries have taken a disastrous turn during the coronavirus pandemic. Great question, Jack. So the variable expenses, so let's just carry forward this example of a grain farm because that's what we're talking about. But in a niche operation or swine operation, cows, whatever, it could be different. But some of your key components are FERT, chem, seed, diesel, those kind of operating expenses. And then basically it's anything you can negotiate and that would stop if your production stops. So for example, in a grain farm, you would not have variable costs to speak of if you stopped actively farming the ground and began to cash rent it. However, if you're going to operate it yourself and farm it, then you will have these kind of input costs. So there's some tools that you can use to try and margin these down. Again, we talked about the throughput, but some other things would be to do a group buying program or go buying in bulk or buying ahead and taking advantage on some of these programs that are offered to get the same product for a lesser amount, shopping around, and then also doing different tests to see what actual seed or fertilizer you need. Because sometimes the lowest cost is that for a reason. It's not as efficient. So from that previous example where we showed the importance of throughput, we really need to be balancing, decisions for affordability and decisions for production. So that's why we've all heard the quote about farming looks pretty easy with a pencil and a paper sitting at a desk. It is, it all makes sense there, but in practice, you have all these unrelated factors like the weather. It's just not as easy to margin those things as you can, but using the data you have historically and making the best decisions and working with your vendors to get the best pricing really helps you with a variable expense. So the ratio calculation here, I'll let Micah go over on how we actually look at that ratio.
Yeah, and so once again, we have this information, we have this data, but how can we break it into something that's actually useful for you and I, right? And so our variable expense ratio, this is what it includes. It's our total farm expenses, but we're going to subtract out those fixed costs. So that rent, the real estate and term interest, and our depreciation. Why are we subtracting depreciation? Well, we all know that depreciation is not going to be a cash expense, right? We're not writing somebody a check for depreciation. So we want to make sure that we pull that out. that is going to give us our farm variable expenses. And then what we're going to do is we're going to take our farm variable expenses and we're going to divide it by our value of farm production, which is going to give us our variable expense ratio. Once again, this is a lot of information. What are the things, now that I know the ratio and how it's calculated and what it is, what is something that I can have at my disposal to be able to make a decision for my operation? And so here's another tool that I would be happy to share with you that we use with our customers frequently. Is on this front page, this is what we call our farm analysis tool. And on this front page, you have the opportunity to go in and put in your ag real estate loans and as well as equipment and any other loans that you have consisting with the operation. I want to make sure it's very clear that you wouldn't put anything like personal debt on here, like student loans or anything like that, that would fall within this because what this is going to do is it's going to tell us our total annual payments for the operation. The next piece of this is we're going to go through and follow our taxes, all right? And so we're going to pull up a Schedule F if that's what we have. And we're going to say that our crop and livestock income for last year was $1.3 million, okay? And then we're going to say that we had other farm income of about $304,000. $1.7 gross farm income, and then we're going to go through and start to put in some expenses. And I won't bore you with doing all of them here, but I do have a couple that I wanted to write down for you, just so that you could kind of see how the tool works. And what it allows us to do then is go to our dashboard and show us where we're spending a majority of our money. Obviously, the more information that you put into it, the better results you're going to get. But now we can sit here and say, all right, my variable expenses from the very limited example that I did for you, right? So let's keep that in mind. The total variable expenses on this was accounted for 73%, right? So that's pretty significant. We want to see under 50%, and we have our risk parameters listed over here for you as well. And then we can start to see what is our return per acre. So again, another really great tool if you are somebody that is a row crop or a grain farmer that's trying to identify the difference between what are my fixed costs, what are my variable costs, and maybe what are some areas. So now that I look through here, I can see that chemical in this example is my biggest expense. What can I do to reduce that? Maybe it's that I can negotiate with my chemical dealer, or maybe it's that I can buy in bulk or do prepaids to be able to reduce that cost. This chart kind of gives you all of that information to kind of get some information from to make a decision on. So now that we've looked at that, let's talk about what our risk parameters are that we really like to see at Farm Credit Mid-America. So our risk parameters, we'd love to see those variable costs below 50%. We do tend to see it in that moderate level of 50 to 55, and then our high risk category is going to be that 55%. When we really have to ask questions about what's going on, why are we having to pay so much more for variable expenses than maybe the people around us, or what are the things that I can do to start to slow that expense down. And the exciting piece about it is that the more that you reduce your variable expenses, the more you can reinvest into your operation, maybe through a fixed asset. So it allows you to expand and grow by reducing it, but it's also really important that when you're selecting your inputs or your variable expenses, that you're doing that you're selecting quality product too. So it really is a happy medium balance, and I think that the farm analysis tool allows you to identify where that balance needs to be for you and your operation.
While we start this conversation on benchmarking and head to the next slide, let's have everybody chat in. Have you guys ever used benchmarking in your operation? So if you have used it, there's groups like maybe Ohio Farm Bureau that you can get to know similar peers to your operation that may not be geographically combating you for land, or very open to sharing information. And what you can do is really leverage the experience and kind of crowdsourcing for farmers to understand how to get better in your business, which is kind of counterintuitive to most farm outlooks. We like to keep everything private and solo, but there's some times where you can open up and learn a little bit more. So let's talk about benchmarking. So what we're doing with that is taking information, comparing your business to other ones, and seeing how you measure up effectively, hence the term. So we would look at that against others. And yes, you're right. There are some from OSU, and there's various other ones we'll bring up here on the next slide. Dairy is good as well. And then you can compare, let's just say, I think there was a niche vegetable producer on this call. Let's say they're having a hard time finding somebody with a very similar operation to them. Or for example, we personally have a very niche operation. Maybe I can't find somebody who's a true peer in the Ohio Farm Bureau network that's willing to share information. Another great way to benchmark is to compare your own financials to yourself year after year and see the areas that you have strengthened or weakened over time and the trends that are occurring there to make corrective decisions or management decisions in the future. The financial benchmarks mostly come from past performance because we're looking at financial or production ratios typically, and we would look at those in arrears. But it is possible to benchmark yourself for future decisions by doing pro formas or projected performance and benchmarking off of that. And again, we can put you in benchmarking of similar farms. So if you want to roll to the next slide. So an example of one that I might use with one of my customers, again, on a wean pig production. This is an example from Agribusiness, which is a company that does it, but there are various different ways to do this, even as simple as an Excel spreadsheet, where we are rating on each area. This one's a production base, not a financial base, what their average weighted percentiles are, where the areas that are challenging for them are, and then the economic impact here of them not being efficient. For example, if you look at the second line, on pigs born live per litter, they're in a very low percentage at 15 percentile, and the economic impact of that farm is $2.2 million. So these are the kind of things that if you are off on, we need to be discovering why, because it's critical to the future of your farm. So again, this is just an example of a KPI benchmark. However, there's other things as well. So this is an Iowa State forecast laid over some lean hog futures, etc. Iowa State, Ohio State, Purdue, all great resources. There's various other university and extension programs. But what I usually do is lay that over and chart it with various different progress points just to make sure the academic information is lining up with other data points that we have. Just again, you want to double check and get as much data into the aggregation as you can. So the sources of data, you're saying, where do I benchmark? And somebody brought up a great point. Yes, there is farm business management associations, your lender like us, we can help because as it turns out, we have a lot of financial information on similar farms, especially being an ag-only lender. Now, we don't give you this is Joe Smith's farm information, but we can say in this percentile of this acreage farmer, you are X. Ohio State, the university system. One that people tend to forget about is their accountant. So you're giving them all your financials, they're compiling it into a standardized form, your taxes. Hopefully you have something like QuickBooks, and maybe they even are taking that a step further, like most of my clients will have a reviewed or audited statement. So it's a very uniform product. They can take that information and benchmark it. And then as we saw earlier, there's various benchmarking companies, kind of like that Agribusiness data we just saw, that show specifically with an aggregation of other like-minded producers where you would end up at and the economics of it. So there's ways to outsource that if you're large enough as well. It's also important to know your data source on what the time period and the snapshot is, because when you think about commodities, there's usually a seasonality and a cyclicality to it. So we want to make sure that we're looking at it over a time period that that's taken into effect. And then understanding how it's calculated, the back part of the spreadsheet, so that you can really understand where everything's coming from. So that is benchmarking. And again, we'd be so happy to help you with that, either our local offices or Micah or I, to help you really understand where you're at relative to your peers, because that's one of the best, awareness of that is one of the best places to help you understand which costs or items that need to help go into improving your overall financial health and viability in the future.
So to be able to benchmark, though, you have to be able to assess your financial position, and that's really what we're going to talk about next. And so the balance sheet is an absolute critical piece of that that assessing your financial possession or position part, right? We have to be able to have consistent information that allows us to see where we've been and where we're at now, and then compare it over year after year. And so it is so important to do a balance sheet every year that tells us what you own and what you owe. And it's kind of fun to track year after year as well. So this is what I tell my customers that I'm working with. It's New Year's Eve. We interrupt this celebration to look at year-end financials, right? The end of the year, we are going to be so excited to be done and put 2020 in the rearview mirror, right? You and I alike. But the reality is we really need to stop at year end and take some time and just kind of reflect on what happened and then capture all of that onto a balance sheet. Why is it so important to do it on 12/31? The reality is because it keeps things consistent. Now, you might say, well, Micah, my fiscal year isn't 12/31. That's okay. Track it with that, right? So I want you to align with whatever works with your operation. But most of my customers are on a 12/31, and so it keeps them consistent. It lines up with their taxes. And then what it allows us to do is say, hey, I have an updated balance sheet and I have updated taxes. I'm going to create what we call accruals, where I can start to track how expenses are flowing through my operation. And so in agriculture, a lot of times we'll buy inputs in, let's say, 2020, and we won't actually reap the harvest of those inputs until 2021. And so having both sets of documents allows us to create one analysis that can kind of tell us the full picture of what's really going on here. The last piece of that.
The other thing. Oh,
go ahead, Jess.
Go ahead.
No, you're good.
One thing to keep in mind is that not all year ends are 12/31. If you're a simple farm entity, a lot of the time that's the case. With most of my customers, it might be like a 9/30 or 6/30, because as it turns out, us farmers don't love to pay taxes if we can help that. So there's a lot of tricks that we can use, like deferring packer checks or pre-buying, that tend to come up in that fourth quarter that can really skew some of the snapshots in time. So sometimes it's a 9/30 and that's okay. It's just about the consistency and that time point and the discipline of doing it.
Yeah, thanks for adding that. The next piece of this, the overall puzzle, is the income statement of how do we track our progress. And an income statement is going to be derived from your taxes. So you're going to bring your taxes to either Jess or I. We're going to send it down to our credit analyst, and they're going to develop an income statement that's going to tell us your revenues, your expenses, and your depreciation. But ultimately, it shows us how profitable your operation is, right? And so it's really easy to sit here and say, compare yourself to either this operation or that operation. But an income statement, what it allows us to do is to say, you specifically on your operation, what are the things that you're doing that is really great, and how profitable are you as a result of doing that? Jess and I have had many conversations before about maybe I have 3 or 4 entities, right? And one of them is making all the money and 3 of them are losing money, right? But we don't know that unless we sit down and we do an analysis and see individually which entity or which segment of our business is actually profitable. And so income statements allow us to get a little bit more of a clear picture.
The other piece, again, with the tax planning, a lot of people, again, try to keep their taxable income as low as possible, which if you like to keep your cash is probably not a bad idea. So they'll do things like buy capital purchases, let's say new paint in the last quarter. Well, maybe we're writing that off in 1 year with like 179 depreciation. Your income on paper may not be that much because of that decision you made, but by having this income statement, we can track that behavior and ensure that we're not penalizing you, even if your taxes are showing that you're showing a loss. If we back some of these tax tricks, if you will, off, then we're able to get a true picture of true operations, not tax planning operations. So.
Now, if you haven't ever met Jess in person, she is a very, very intimidating person. So, Jess, how can I meet with you?
Yeah.
You're a lender. How can I meet with you, come prepared, and feel confident in what I'm doing? I work with young and beginning farmers all the time that will tell me, Micah, it's a little intimidating to sit down and tell somebody what you own and what you owe, because what if it's not good enough, right? And so what we want to do is we want to wipe away those fears and tell you that there's not a single person, that Jess and I work with that wouldn't be willing to have a constructive conversation with somebody that wants to have that conversation, that wants to grow their operation. And Jess is going to throw out some tips for you on how can you meet with a lender no matter what stage of the game you're in.
Thanks, Micah. So I farm myself, so I'm on both sides of this desk. So I definitely empathize with you on how this works. But the one thing to keep in mind is, much like a lawyer or a doctor, a banker cannot share your financial position with anyone. That is illegal and against our ethical code. So whatever you tell us is confidential, and we are keeping it that way. But the other key thing to remember is, although it may be intimidating, this relationship is like any other good relationships and is really based on trust and communication and transparency. So if you are going to meet with your lender, being open and honest about not only the great things in your operation, but some of the challenges you're facing or generational transitions coming up is important. We would also like to have you be as prepared as possible and bring some of the items we've been talking about. So being a lender myself, when I meet with my loan officer, I actually already have everything all figured out and basically just want them to stamp it. I don't expect that for people that are not in banking, but you should really have put some thought into this. We're both investing capital in these projects, so we want to see that you have put a lot of thought and effort into this as well. And then also, your lender shouldn't be a yes man. I mean, if your lender is always saying yes, either you're really financially stout, which is a possibility, or we're not having the real critical conversations. Just because the land 2 miles down the road is up doesn't mean we have to buy it. Let's model this using the financials and understanding, even if you can technically afford it, to ensure that this is the right commitment for your operation. Sometimes we forget in farming, because of the nature of this business, but most consumers wouldn't start buying $1 million assets or, $300,000 combines at will. That's more than their house. So never lose respect for the amount of money that we're playing with in this, and making sure that even though this capital is required, it might be a lot, that the income that this will produce makes sense and it's not an emotional decision. And if your lender says yes or no, understanding how they got there and talking through the pro formas or whatever analysis tools we've used. So when you are coming to meet with me, because I'm so intimidating, I guess, what we'll want to know is to be prepared. So management, who are the key decision makers? Who's doing what in the farm? What can we expect from that standpoint? Who's putting the hedges on the board? Who's in the tractor? Who's doing the QuickBooks reporting? A business plan, especially important if you're new to farming or this is a new venture. You really need to spell out for us how this is going to work so that we can understand your plan and then model it ourselves. If you have issues with your credit history, explain those up front. We will ultimately find out, but transparency on the front end is very important in explaining how that happened and how things are corrected. Balance sheet and income statement that we were talking about earlier. Those are kind of the anchors to everything. Do you have the liquidity for a down payment? Do you have the equity to do this? Do you have the free cash flow moving forward to support this request? So the top producers, when talk to our retail teams, that they talked about are the people that are continuously improving and seeking feedback. They're not complacent in what they're doing, and they're always trying to find a way to get more margin out of their operation and compare and get feedback to get better. And I think that resonates with the benchmarking and some of the other things we discussed. They're doing accurate, consistent information. If you come to me with a shoebox, I've already got in my mind that you probably don't have your financials under control. But if you print me off your QuickBooks report year to date and can tell me what your P&L is, that's going to make me feel a lot better about the consistency and the integrity of that information. You don't have to be a financial expert to do some of these things. A lot of this comes in knowing the right teams. Do you have a mom that's working part-time down the road that could input your QuickBooks for you? Do you have an accountant that's running it? Do you have a sister that can help? You don't have to be that person, but you do have to build a team of excellence around you. And then ability to have a constructive conversation. If you're not being transparent and open and helping us help you, then it's really hard for us to build a level of trust to lend millions of dollars in some cases to you guys and have the faith that it will come back. So overall, we want to help people, but we need them to be able to articulate what those plans are and how they will get there. And as you know, Mike and I work for Farm Credit. We think part of building the team is really getting a lender that understands agriculture. So Farm Credit or Ag Credit, if you're in that territory, they do nothing but agricultural lending. So we're committed to that. We're not getting out of it. And we already understand your business and can help you take this deeper dive rather than just flipping you out a note to sign on the viability of your operation. And the other piece is because we're a cooperative, the profits that we make come back to you in patronage, which can be about 1/3 of your interest to half of your interest, depending on what you're paying. And that kind of free cash flow that comes to you in March in a check really helps with tough years like we're going through right now as well. So we really think that aligning, much like you wouldn't have a cat vet work on your dairy cow, same with the team of excellence you build around. Get an accountant that knows agriculture, a lawyer that knows agriculture, an insurance company that knows agriculture, and a bank that knows agriculture, because it's very important in this commodity business. It can be very tough at times, but you're getting every advantage possible. So the action items that we hope you take away from today is creating accurate income and financial statements. So start wherever you're at and try to get it to the next level. If you're in a shoebox, get to QuickBooks. If you're in QuickBooks, if warranted, go to reviewed statements and get those numbers to a point where you can really manipulate them. Evaluate 3 variable costs that you can leverage down and where you're off against your peers, and then write down a goal for your operations profitability. I guess at this time we could open up both chat-in and the verbal questions and talk through anything that you guys might have. But again, I know this subject can be a little dry, but I think we can all resonate that making money and keeping your farm is really the core of it. And we're trying to give you the tools as much as possible in an hour at lunch to get into that end goal.
I had a question regarding some of the benchmarking. So I know you as an ag focused lender, you've got kind of a really strong overview for many operations. Do you have, for some of the like you said, Jess, you have a small niche operation. What kind of resources do you have for benchmarking for some of the small scale niche operations?
Yes. So that's a great question because, again, I'm living that day to day. And my brain is a little bit bankery on a good day because of my profession, but we're selling niche meats on the weekends. So while we don't have, like a niche meats or a mushroom farm or an aquaculture benchmark, what we can do is you peel the onion back almost like the making widgets again. So rather than sitting there and being like, I need to find 5 similar farms to this, in that instance, we need to look at what's the economic engine driving it, which is generally working capital or cash flow. How much are you doing relative to a standard business of a similar size and scale, which we call multiples of EBITDA if you've ever had banking or cash flow classes. And then how much room is in your balance sheet or a reserve in case you hit a down cycle. So we kind of almost go backwards with that. And then if we're finding risk areas, that's when we take a deep dive. Like we probably need to explore these areas because we have weakness in this, and then relate that back to a niche operation. Does that make sense? Is that like a bunch of banker jargon, or are we close?
No, I know it did make sense, and it was a bunch of banker jargon. So 2 for 2.
Basic. If it doesn't fit into an existing benchmark of a standardized commodity, we look at it like any other business for viability is the short answer, and then help you identify risks. But for example, like dairy, there's Nitsky and Foppel, the accounting firm that literally has benchmarking, or the OSU Dairy, or our internal, and you can kind of compile all these different benchmarks to find the right answer that you're looking for relative to your peers. But I do think that's a great area that Farm Bureau can come in, because when you start connecting with these other niche producers, you'll find the synergies, and you can have those transparent conversations where a lot of the time you're going to learn more from that than, you know, financial metrics anyway.
So the moral of the story is don't go at it alone. Get some trusted partners and surround yourself with people that are going to push you.
Certainly a great presentation. Really appreciate both you, Micah, and you, Jess, for taking time out, and the folks at Farm Credit Mid-America for helping to bring some of this information to our members.
Thank you all very much for joining. Jess and I really appreciated the opportunity to share some of this with you. Farm Credit Mid-America always wants to be a resource to you all in agriculture, whether you're actively within production or not. We would love to have a conversation with you and be a resource to you. So we hope that you'll reach out to us. So thank you.